Thank you, SOSV. I'm really glad to be here yet again. Now, while AI startups raise billions of dollars, venture capitalists are having a slow fundraising year. KPMG reports that VCs around the world have raised about $81 billion through the third quarter of 2025. That compares pretty poorly to $196 billion in 2024. Now, the picture in climate tech is even more stark, with just 17 funds raising around $2 billion this year. That's down from a record of 94 funds in 2022 and a record $10 billion in 2021. My question is why? A global data center frenzy is spiking power demands, straining grids, and changing the conversation around power generation and storage and grid durability. It seems like the perfect moment to be investing more, not less, into startups that can improve how we build and power the future while also keeping our planet healthy. So, to help us understand the state of play, kind of where climate tech startups are excelling and what could be holding back capital that investors would love to put to work, I'm joined today by Tove Larsson from Norrsken VC. Tove, how are you?
I'm great. Thank you for having us.
Yeah. We also have Sophie Purdom, a partner over at Planeteer Capital. Sophie, hey.
Hi, how's it going?
Really good. And also the excellently named John Tuff, managing partner over at Energize Capital. John, how are you?
Great. Excited to be here today. Thanks, Alex.
Yeah, right. So the first thing I'm really curious about is how were you all able to raise funds for climate tech thesis when there seems to be such a dearth of capital and LP interest? So, John, you have the largest fund, so let's start with you. How did you pull off the nearly impossible?
Yeah, the numbers are large. It was a $430 million fund, but it was definitely not easy. Just to make it really clear. It was our third fund for our venture capital strategy. So we've had history in our first and second vintages to show returns and track record, which was critical. But we also have notably focused on certain pockets of the landscape which are more resilient, which is more capital light strategies. That resonated well with the limited partner base, both domestically and then importantly abroad. A big part of our focus at Energize has been to identify markets that are more resilient to the climate movement. And the U.S. has big highs, it has big lows. Frankly, from policy and from potential leadership. And Europe is much more consistent. And so we also went to Europe for more limited partner engagement for that fundraise.
All right. Now, Tove, you're based out of Europe, and it sounds like John's giving your side of the pond quite a lot of props. Did the same tailwinds help you raise your fund?
I would agree to that, yes. There's been, of course, a lot of noise in the US in particular. But what we see is that, the language might be changing, but the underlying fundamentals in the industries that we're investing into is stronger than ever. And kind of the LPs that understand that, they will be really kind of leveraging an opportunity of a lifetime. So we definitely saw traction, especially with the European LPs in that sense. And we're really happy to close our biggest fund so far at 320 million euros.
All right. And then, Sophie, same question over to you just to wrap this up. How did you manage to pull it off?
Thanks. Yeah. Gosh, I need to add a 0 or something to my fund to be a part of
really
this group.
It's kind of small compared to the rest of the team.
First time fund. It's like truly impossibly hard in this market. It's major kudos to Sophie.
No, John, you're dead on because emerging managers, first-time funds are really struggling this year in particular, and climate is having a hard time. And that makes Sophie, I think, a double unicorn.
Yes.
Okay, stop. I'm blushing. This is bad. What was the question? How did we do it? Let's see.
Yeah, how'd you do it?
To kind of announcements are exciting moments, right? In reality, just like what John was saying, this is not a flash in the pan moment. This has been a steady, concerted effort to build a real momentum and trend, and frankly, just like search for the true partners that we want to work with for, it sounds lofty, but like really decades. And so, there's a couple jobs to running a venture fund, and an important one is go get the money with the people that you actually want to return and partner with. And so that's been an around the world experience for me over about a 2-year period, starting from I'm not a spin out manager, and unfortunately, I wasn't able to seed the fund with my own money yet. And so it's been a matter of going and finding those partners, be they sophisticated family offices, be they university endowments, be they US or Australia or Asia or kind of European based. And we've been lucky to find a mix of institutionals and then frankly, a really kind of like long tail of highly engaged folks that see Planeteer as a thoughtful, concentrated, pretty data backed, and then also leaning kind of, we orient more towards capitalization and business model in terms of our focus and kind of diligence area, versus there are many of our peers who are phenomenal technology, like pure technology, deep tech, hard tech, whatever the word of the day is, investors. We tend to skew more towards founders who are helping their customers immediately make more money and simultaneously are helping those customers reduce a fat tail risk. And so happy to kind of chat more about that. But I think this crew is like really kind of starting to hone in on how do you invest in companies that help your customers make more money that happen to be climate thematic.
Before we get into that, I'm curious how much more capital you three could put to work if you had essentially an unlimited LP checkbook, because you did put together funds in a hard market, but how much more opportunity is there compared to your current capital base? And how much are you effectively being forced to leave on the table because you have to be selective given your current fund size? And Tove, let's start with you.
Yeah, and I think like from our perspective, the deal flow is stronger than ever. Now, primarily speaking for Europe, so I'm curious to hear my US colleagues, but we think that we could deploy even more, both in terms of kind of expanding our geographical reach throughout Europe, and also doing larger tickets. So there's definitely more to be done here.
John, could you put together, I don't know, could you put 10 times as much capital to work, or 5 or 2, or what's the upper limit of great companies to fund in the climate tech space?
Yeah, if you look at the history, the peak amount of capital that was going in the first wave of clean tech, and it's funny, it was clean tech. We can't use that word anymore. Now it's climate tech.
Yes.
It was about $5 billion a year. I think realistically, the market's 10x since then. And yet the number of managers has stayed the same or fallen in the most recent wave. I think our sector peaked in 2021, 2022. But to answer your question directly, of a $430 million fund, we brought in a lot of institutional LPs that come into third-time funds. These are pension groups, international sovereign wealth funds, and the largest they can usually do into a fund is about 10%. So $30-40 million checks for us, and that is so small for these groups. It's irrelevant. So their hope is that the firms will scale. Their hope is that they can do significant co-invest. We have firms that have told us that they hope for hundreds of millions of dollars exposed to the vintage of which we're investing. So I think there's probably 3 to 5x the capital we could be deploying. We won't, but we will do a lot of those co-invests.
Does that mean that your fourth fund then, I know we're getting a little bit into the future here, but does that mean you're going to target a much larger total fund size for Fund 4 so you can take on bigger checks from these LPs that do have interest?
It's interesting. When we started this fundraise, we were targeting about 350, so we did exceed the target. But the valuation environment has actually got improved for an investor in the last 24 months. And so our ability to achieve our target ownership, which is around 20% in the company, we'll be able to do that with lesser capital. And so actually the fund we have now, it's perfect because we can own even more companies. But I wouldn't want to get much bigger. There's a sweet spot for these stages. We're more Series B focused, commercialization stage.
Sure.
The flexibility of good LPs to scale up when you want to is really valuable. But I think this is a good range.
Tove, you were nodding your head there. Do you want to weigh in?
No, I'm just echoing John that I think like there is certainly a sweet spot for funds in kind of our part of the value chain, and using the LPs for co-investments is, I think, another kind of great way to kind of really double down on the companies that we believe in the most. Maybe another thing to add is that we're also seeing in Europe, and I think it's similar in the US, like a lack of capital in the later stages.
Yes.
So to be able to expand into more kind of growth-like stages, and that's an area where we see a lot of potential and where we could deploy significant more capital.
Sophie, do you see a similar kind of funding gap in this, I don't know, let's call it the Series C plus range? I know your fund's a little bit smaller, but I'm curious if you see that out further down the horizon.
Yeah, and I'm happy to chat specifically to some of the data. So putting on another hat, I'm part of an organization called Climate Tech VC. I think we heard earlier in the day from my co-founder, Kim Zoe. And so CTVC, for those who are not one of our 80,000 odd subscribers, is a free newsletter. And amongst other things, we track all of the deal flow activity and project level activity, basically all of the money flowing through this broader climate space. So if we want to kind of like chat specifics there, of course, like from Planeteer's perspective, I echo what folks are saying of it's really nice to have a nimble, right-sized fund. I think it's no time like the present for ownership in the best performing companies, right? Rather than we're coming off of what felt like more of a perhaps like index frenzy style approach of the years before. So I like that we've all right-sized our vehicles. If I were to have a unlimited amount of capital to deploy, I would not try and force all of that into the pre-seed and seed stage. I would heavily barbell that strategy and perhaps not myself being the core manager, but would partner with folks who are best in class at identifying those other kind of arbitrage or mispriced moments in the broader climate space, which I think is perhaps still early infrastructure or perhaps some like distressed series, maybe B-ish kind of stage where folks are like at a solid growth rate, but not an outstanding growth rate. A lot of businesses look almost identical. There's probably an opportunity to roll together those businesses and then kind of quickly flip them for exit. But we'll kind of put that aside. Putting a CTVC hat back on, practically speaking, right? If about 30 billion of venture and private equity growth funding was deployed in last year, 24, that's a 14% drop off from the year prior, but a 24% drop the year before, right? So we're coming down off of the peak. What's interesting and also kind of exciting, I suppose, for me and for folks that are investing is the deal count has not actually changed.
Correct.
So we're talking about 1,400, 1,500-ish kind of new companies that are getting funded every year. That's a really active environment. And like Tove was saying, there's actually a bit of a shift away from the epicenter of like it just being Silicon Valley to then we saw New York being kind of like very fast follower. And now a really solid shift of Europe is like fast catching up. So lots of companies, they raise incrementally less each deal. And a majority of the money that's fallen out of the ecosystem continues to fall out at the Series C and D stages.
Okay. Now, I'm a little bit surprised by the positivity here. Not that I'm annoyed by it, but, talking about how, LPs over in Europe have their mind in the right place and valuations are attractive. Because I was looking at data before we got together, and according to Sightline Climate, they ran an investor survey in the climate tech space, and they found that 42% of VCs thought that some strong companies will fail due to funding constraints, even though they're solid businesses. So can someone explain to me the contrast between what you guys all just said and the fact that a lot of your peers are concerned that a capital dearth is going to effectively kill off some very promising businesses? And John, let's start with you.
I think both of those statements can coexist, which is excitement and there's strong new budgets becoming available for climate opportunities, the hyperscaler segment. But when you think about that phrase of a good company may still go out of business, in this space, there's regulatory influence, there's policy, there's international trade, there's interest rate influence, there's all the regular issues of running a business, the people, the markets, the TAM, the economics. And you can control only so many of those at any given time. And what we're seeing today is a drying up, as Sophie mentioned, of capital at the later stage. So the cost of capital for a later stage company has increased dramatically. I think that's partially driven, maybe significantly driven by those later stage investors who tend to be more generalist in nature, leaving the space, the sucking of air, going over to the data center world, going over to these other areas where a lot of capital is being used, and the ROI, at least the promise of ROI, is high still. Whereas the climate ROI in the later stage for some of those infrastructure type businesses has underwhelmed in the most recent cycle. And so I think that it's that issue, which is just the number of later stage firms leaving is raising the bar. And so the goalpost to raise a new round is probably pushing out further and further. And some of these businesses just need cash. They aren't as capital efficient just by design. And so I think that's the reference. And for us, that's unfortunate because we call it headline risk. Headline risk is very dangerous for the climate market because it's easy for people to glob onto this concept of very visible, very tangible projects that go out of business. And then that's when your parents call you and ask you, are you going to be okay? Is your industry going to be okay? And the answer is yes, of course it is. But the press frankly loves to talk about those things. And so you just have to get beyond it and focus on the fundamentals.
That's because the press is also accustomed to reporting on its own demise, John. As a member of another struggling industry, I'm sympathetic to that. Tove, it sounds like then that we shouldn't expect generalist VCs to show up and plug the gap in the later stages of climate tech investing, where we do see a lack of capital. Is that fair?
No, I think you're right on that. And something we do see more and more of, it's the infra funds that are getting more excited about the kind of companies that we invest into. And I think it's almost like a new asset class, like VC infra type of investments. One example that we've invested into is TerraLayer. They do grid scale energy assets with software on top. And that's an example where we see great interest from this next generation of infra funds. So that gives us quite some hope. Yeah.
I want to get into electrification and the grid and some deals there in the AI realm in just a moment. But Sophie, before we all got together, you framed your investment strategy as, quote, backing companies that help their customers actually make more money while reducing risk, in opposition to what you called the green premium obsession. Tove, you wrote to me that you think about something called impact optimism and kind of impact investing. To me, those feel a bit like they're in tension with one another. So why, Sophie, are you so opposed to, if you will, kind of the green premium and impact, while Tove is a bit more amenable to that perspective?
Well, first of all, I love that and have this conversation about we'll find out in 10 years plus if one is more successful than the other. And hopefully we're all making the world a better place and making a bunch of money with it. So perhaps mine's being a little bit sharp, and it's easy to kind of do contrasts, right, of like how theses have changed over time. So bear with me. But what I'm at is like purposefully trying to point a bit of a foil between what I perceive from Clean Tech 1.0 to be business models focused on purely efficiency, which feels inherently not exponential, or it's kind of do more with less, versus I see the opportunity today in this, if you will, new energy era where we've come out of, I think it's just like a really, really essential takeaway. And I know the rest of the day of all of this content will be talking about this, but we're finally in a period of a more energy consumption, not just kind of like flatline efficiency. And I think that changes everything. So that's what I'm getting at by customers, making more money or consuming more, mostly from like an energy perspective. And so we like to invest in some of these companies that, for example, would allow their underlying customers to push more electrons through their existing infrastructure, right? So by partnering with a startup, the company makes more money, sells more electrons, and simultaneously is reducing a risk. And so I think that there's that two-part, that like twofer of stuff is just more volatile, weirder, wackier. You can call it climate change. If you want, you can just call it volatility, if that's easier for you. So we like the ability to then help our customers avoid their infrastructure failing out, right, on the flip side, while they're maximizing it and making more money off of it simultaneously. So that's what I'm getting at. And then I think my critique at a high level of the green premium piece is that's super smart and makes a ton of sense in a different interest rate environment. However, and if you can optimize that to bring that business to completion within the time period that interest rates are close to zero, that's fantastic. And you should go do that all day, every day. But lots of these companies in climate require 5, 7, 10, 12 plus years to get to a period of stability. And if your premise is that interest rates remain extremely low throughout all of that, and then the day or the year before we hit a different interest rate, that there's a flip, then if the time period before is moot and kind of or not. So that's my kind of like quip to what I'm getting at with why I think green premium does not work long term.
So Tove, has a higher interest rate environment destroyed the green premium and made impact investing less attractive, or is there multiple stories going on here at once?
I think, I 100% subscribe to Sophie's statement that we cannot rely on green premiums the way we did a couple of years back. That was kind of a given in our space in many industries. But today, kind of the solutions that we back need to be faster, better, cheaper, and they really need to be kind of self-sufficient in the way that we cannot rely on people wanting to do good to buy these companies' services or products. And I think how I couple that with still impact optimism is that we see so many opportunities now coming with AI plus climate. And the kind of AI in itself is, of course, kind of a key tool to make different industries more efficient. And with that comes better, faster, cheaper. And in many of these industries, that also translates to energy savings, et cetera. So kind of coupling these two opportunities, and I think that's one of the reasons why when we did a study now earlier this year, we saw huge optimism for impact companies. And I think that's kind of on the back of kind of using AI to tackle some of the biggest challenges that we're seeing. So we saw that 75% of the investors that we surveyed wanted to invest more into impact companies. And that's not based on the green premiums, but simply because these solutions really now make sense.
Does impact then, Tove, simply mean like just more efficient business results coming from what the company does? Because that sounds like a fancy term attached to normal business, if I could be kind of crass about it.
I think over time, impact could be a very mainstream word. I hope so. And you're absolutely right that, I mean, it comes a lot with efficiency, reducing energy consumption, reducing emissions, et cetera. But impact to us is really kind of tackling the biggest challenges we see out there.
No, that's fair. All right, well, let's stop avoiding the elephant in the room and talk about what AI power demand is doing to our grid around the world. We're seeing incredibly quick growth in power demands. We're seeing grids buckle. We're seeing startups work on everything from wind power to better batteries to electrification of cars. It's a really exciting time out there. And you guys have a lot of companies in and around this space. John, you've backed Grid Status.
Yes.
And you've also backed Aurora Solar, which helps do software for solar buildouts. Where's the best place for startups to play in the current electricity market? I presume they'll have an impact in many different places, but where does Energize Capital think that they're going to have the biggest impact? Is it production? Is it storage? Or is it software to help with buildouts?
Yeah, so to hit the first point here, I've been in this space for about 20 years, which makes me one of the longer tenured folks. And this is the first time in that 20 years where we've had demand, like true demand growth on the energy side. So to Sophie was saying earlier, growth necessitates innovation. Historically, if a new asset or technology wanted to come online, something else historical had to come offline. It was like one on, one off. And in this environment, it's like the demand era, like you just need more of everything. You need more production, you need more efficiency, you need more resilience. And that is when traditional venture capital has done very well. When you're saying it's a time to revenue or a revenue quality problem, it's cost savings. You're competing with your own margin eventually. And so I think the focus for us has been on, listen, I think it'd be really cool if nuclear could be here in the next 3 or 4 years. I'm not so sure it will be, but we do have a demand crunch in the next, by 2030, we have to add another like 20% to the power grid. And so what are we going to do? There are technologies here today. There's solar, there's obviously batteries, despite the US being negative to wind, there's wind. And then there is natural gas. There are other tools in the sphere. And so we're looking at it as how do we get new assets online faster, which is opportunities like Aurora Solar for rooftop solar design. And then there is, with the assets we have, how do we optimize them? How do we maximize the grid? Assets like Grid Status for us, which help monitor the grid and make recommendations. And so we're looking at it in both tranches, but the fun part is it's a more discussion. And the revenue opportunity for these companies, it used to just be a utility or maybe an energy developer. But now you have the largest companies in the world, Microsoft, Meta, et cetera, becoming customers of climate companies. And so the budget has expanded materially. The TAM has expanded materially. And that's why, it's funny that this is actually the time the generalists have left our market because it's the best stage, to Sophie's point. And it's the fastest growing companies we've seen in our history.
That's why the contrast between the need it seems we have right now for better climate tech and the current level of capital flowing into it, you guys being the exception, just kind of makes me almost a little angry. Like it feels so backwards right now. Like it feels like you guys should be swimming in cash and just, so busy dispersing more funds. And the numbers don't quite back that up. Now, Tove, you're in Sweden. And I know that the Nordics are doing pretty well in attracting a lot of data center investments because of, a cooler climate and access to, I think, renewable energies and so forth. Your firm backed Vind AI, which is software for wind power development. What role do you think software products are going to have in assisting the energy transition that we need, as opposed to investing in companies that might be, for example, designing more efficient windmills themselves?
I think getting there will require both the hardware and the software solutions, and I think climate investors will need to take the hardware solutions into account, because I think, like you, John, said, I mean, there's huge value in that space. At the same time, I think the software solutions can really help accelerate the transition here. So, for example, what wind does is to really kind of help figure out kind of where do we put the windmills so that it yields the best kind of amount of energy. So I think software, again, can help accelerate and enable, but the hardware will really need to be there for us to solve this.
Sophie, can you weigh in on the hardware-software divide? Because one thing that I did learn when going through each of your three portfolios was just a lot more software than I anticipated, in a positive sense, to be clear, but it surprised me a little bit.
Because there's a traditional premise that a lot of climate tech investing is hardware investing.
Absolutely.
I'd kind of like rebut the hardware versus software kind of dichotomy in the first place. And I've been tripping over myself trying to find the right phrasing for this for years. But I say that a majority of interesting climate tech investment is hardware-enabled software, which essentially is a hat tip to the fact that, of course, we're operating with real atoms or electrons, but often the optimization and the kind of like upside comes from some software-esque layer on top of it. So we like to work with founders that are brave enough and smart enough and aggressive enough to be able to kind of like do both business models at once. So an idea of that would be there's a lot of kind of like next generation light hardware in market that can have a massive upside, whether that's information and like data collection or lightly tweaking kind of like existing large infrastructure. And then a lot of optimization and frankly, like physical AI layers that are on top of it. So we're happy to play in that space. I have said this for 6 years in the newsletter, but I don't think it's venture's place to be taking enormous kind of science style bets that require 10 years plus of capital intensity to play out, especially while we're in this period now of it's all about time to power and like time to scale. That's kind of long-winded answer to that. But let's keep in mind that the folks that we're in partnership to make money with have goals and intentions as well that are perhaps different from how some of the funds that look like our peers on paper, like, and we love to partner with like a Breakthrough Plus, right? They have different underlying limited partners who have slightly different goals. And so for some funds, they're set up to be able to take longer term, more intense, take more zeros, right? And then have more kind of catalytic impact than perhaps the three of us do.
On the idea of hardware-enabled software, you backed a company called Tove Labs, which is bringing AI into the world of, well, let's be honest, HVAC, but it struck me as an interesting way to try to limit energy consumption using software and kind of modern tooling in a way that could limit grid, pain in the near term.
Yeah, and also just frankly make more money for the contractors that are managing all of those assets. And so Thalo is an amazing business. We've been lucky to partner with them for a long time. It was actually our first deal out of Planeteer. And we invested many, many years ago, actually, and would totally partner with this founder again. He's a phenomenal and really gritty engineer meets business mind. And we started back when the carbon markets were much more robust with point source carbon capture. And so imagine the grittiness and velocity that this team has had to do to pivot from that through to now finding like the moment in this physical AI using those same sensors. This guy made all of the hardware for Waymo and Cruise. So these are like real space grade sensors that are now applied dirt cheap to HVAC infrastructure, which frankly has a ton of optimization left in it, be that for the energy efficiency side, but no one really cares about that because electricity is still like reasonably cheap, right? Through to, more importantly, the uptime and reducing labor costs. And so that's a perfect example of like hardware enabled software. There's a very light device on the infrastructure or on the equipment rather. And then it's all about optimization and helping the workforce be way smarter and better at their job, getting more people with less gating, labor requirements. We can go get people straight out of, trade school or even before that into these jobs, keeping our equipment up. And there's a lot, I'm in New York, there's a lot of this infrastructure that's on its last legs, but doesn't need to necessarily be flipped out just yet. And so it's making the most of stuff that isn't super capital intensive to put a bunch of new upfront cost into.
On the concept of software, Tove, you said to me that climate is one of the most interesting frontiers of AI, which I thought was a pretty cool comment. And I know you've backed a company called Indra, I believe. They do kind of AI-assisted building design. What impact is AI going to have on unlocking new opportunities for startups to kind of go into the world and make what we currently have a lot more efficient?
I think, we're seeing such a huge gold rush now into AI with, I think it was $110 billion invested into the space last year from the VC investors. And what we're seeing is that, we're seeing such a surge to all these kind of efficiency gain solutions and sales robots and so on. And we see a big risk that many of these solutions will have huge churn over time. And that the kind of AI builders out there are missing out on the biggest opportunity here, like cracking the real challenges that will see demand for such a long time, where you will not at all see that same volatility in demand. So we see lots of applications in that space, in climate in particular. Where you can apply AI, for the example you mentioned, Enra, to design buildings in a more sustainable way. You can use AI to make cement production more sustainable through a company we've invested into called Alchemy. You can use it in the processing industry to reduce energy consumption. Company we invested into is Juna. So the number of kind of opportunities here is huge. And we've just kind of launched an initiative called Prompt What Matters. What we really want to inspire the AI builders out there to go build solutions to problems that really, really matter. So that's something we're excited about and where we expect to see great kind of success stories going forward.
Tove, we only have a couple of minutes left, so briefly, if you could, but do you think climate tech companies that use AI in their product or service should simply just brand themselves as AI and drop the entire climate moniker or label? Because it seems like, back to Sophie's earlier comment about adding a zero, there is just so much more capital available for those companies right now. Perhaps they could politely confuse VCs into giving them more money faster.
I think if these builders talk about kind of what their solutions can do, it is really building faster, cheaper, better solutions. And I think that's the pitch that they should have. I think we as investors might have different stories, depending also maybe a little bit on what crowd we're talking to. But all in all, this is just words. And if we look at the underlying fundamentals in our industry, I think we can all agree here that kind of everything is pointing in the right direction, and that AI will really help kind of give this another push.
All right. Now, John, you're out in the Chicago area, right?
Yes.
The heartland of America. And our nation is making some interesting policy choices. I live, my neighbor was working on a major wind farm off the coast of Rhode Island that was temporarily canceled by the Trump administration and then brought back. It's very uneven. You mentioned also that, LPs over in Europe are a little bit more on the ball when it comes to climate tech. Why are we so backwards right now? And what impact does that have on domestic climate tech companies?
Yeah, I mean, it's the question we have to answer every 4 years. I would say this: the beauty of the customer base for a lot of climate companies is that the buyer somewhere in the ecosystem that's approving the budget is an engineer. And most of the tools, to what Sophie has been mentioned earlier too, are faster, better, cheaper in some capacity. And so those ROI decisions are being made behind the scenes. Now, when there's massive policy level wipeouts that can happen, like offshore wind in the States, frankly, you just have to be more resilient as a company. If your only focus was offshore US wind, you're probably in a tough spot. But good businesses have good horizontal revenues. And I think that's one really important note. The health and quality of a climate business is the same as every other business, which is good revenue diversification, cross-cycle support. sometimes people like to say, oh, there's a green premium. Like you mentioned, actually, there's a green discount. Like these are harder businesses to run than most. You should be getting a lower entry valuation for the risk you're taking. And so and when we have environments like today, which is frankly, I think there is a green discount, these are the vintages you want to be investing in. To your point, Alex, this is the time because complexity keeps the generalists away. And the market feels really complex unless you're behind the scenes and you know where to invest.
So, I mean, I guess optimistically, that means we should see more people pilot in if the economics are where you put them. But let's end on the most positive note possible, my friends. I want you each to tell me which company in your current portfolio is likely to have the single largest financial outcome.
Oh my gosh. Keep in mind, we invested 6 months ago. This company has been incorporated for about a year. But I think a company called Grid Astra is extremely well positioned to help the customers make more money and reduce the fat tail risk by putting more electricity through existing grid infrastructure.
All right. Short and sweet. Tove, your current favorite from your portfolio.
It's like you're asking us to kind of choose between our kids, but I'll choose one of them, and that's Submer. It's a company that they started out focusing on cooling for data centers, and are now kind of building like a full orchestration layer to make data centers more sustainable and cost efficient. So arguments both for work for both crowds.
John, same question to you. Portfolio company with the largest future financial outcome.
Yeah, you mentioned earlier, Aurora Solar is the rooftop solar design platform for residential and small commercial, from permitting all the way through approvals and in the design process. It's still the biggest market for net new energy opportunity in the States the next 3 or 4 years. It's huge in Europe and growing. Energy prices are going up, so the ROI for a solar payback is going to increase. Every solar site now has a battery with it to help with the resilience narrative. Rooftop solar is a massive and growing market, and Aurora is the number one player in it for software.
All right. Well, guys, I'm really glad we got together. I am more optimistic than I was going in, which is always a great place to be. Let's fix the planet. Let's make a lot of money. Thank you all for coming.
Thanks, Alex.
Thank
you
Alex.
so much. Bye.
Bye, ladies.
Bye.